In this episode, Mike and I will be exploring when's the correct time to start planning your business exit strategy, the biggest misconceptions when planning your exit strategy, examples of where it does and doesn't work in your favor, how to align your financing options with your business exit goals, and the fundamentals of becoming sales ready. If you enjoy this episode, don't forget to subscribe to the Inner Circle Boardroom Visionary Business Builders. You can find us on YouTube and LinkedIn. Hit the bell notification to stay in the loop. Now let's get this show on the road. Mike, welcome back. What I thought we can do in this conversation is to start off by exploring why should business owners consider exit planning essentials, even if an exit seems years away, and when to actually start building this into your strategy. Share some examples of businesses benefiting from planning early versus the challenges due to late and last minute decisions.
The answer is depends what sort of business we're talking about. So if you are a business that's been through a buyout of some description with private equity, then you'll be planning an exit from day one. You'll be planning it with your investors. You'll be planning it with the management team, and you'll be kind of thinking about where you want to take the business, how you're going to exit. If you are a private business and it's a family business, it's been going for many years, but you're a generation that's thinking on exit, then it'll be very different. At that point, you've really got to think about what the family goals might be, what the shareholder goals might be, and begin to think about where you want to take the business ahead of an exit. The things you need to think about, and you need to think about them a good number of years before you think the exit is going to happen, is who might be potential pool of buyers for your business. And try and think as broadly and widely as you can. Because when you start to think about who might buy the business, you start to think about the things that they're going to look for. Any wrinkles that you've got in the business that need to be ironed out before you get to a sale. So, for instance, you might have set up associate companies along the way that are all part of the group, do the same thing, but aren't properly incorporated. Get some of that legal structuring out of the way early to make sure it looks neat and tidy for a prospective buyer. You need to think about how you're going to present it. So, who are you going to present with the business? Are they going to be taking the management team with them? If you're a founder, are you still running it? Do you need to get a chief executive in to kind of take over from you, ready for a sale? Lots of things to think about how a buyer would take your business on board. So you can never really start too early, but I'd certainly say you need a couple of years preparation at least.
Can we talk about business valuations, because they often led by the markets, and you'll speak to an individual and they'll have an expectation of what their business is valued.
Valuations are an emotive subject, so it's a bit like your house. When all houses around you might go down in value, you never think that yours has gone down in value. Businesses are pretty much the same, yet they go through cycles. At certain points they're attractive, at other points they're not. So valuation methodology is quite a difficult process to get everyone comfortable with. I think it's hard to focus on that valuation 2 or 3 years in advance of preparing the exit. All you can do is prepare the company for a sale and then look at what market sentiment is like at the time. If valuations are low in the cycle, then you might decide to put the exit off for a few years until markets recover. Because you're right, they're impacted by lots of other things. One of the things I have noticed over the years is how they come in waves. So one particular sector will see a business sold to trade or to private equity, and then you will see a flurry of other businesses in the same sector come to market. And that can happen because either the advisor who sold the first one then goes to find others because he's done lots of the work around the sector, so it's much easier for him to go into that. But also other competitors in the sector think now might be a good time for us to sell, particularly if there are good willing buyers out there. So we'll take advantage of the wins that we think are going to be in our favour. So valuations are emotive. How do you base them? I'm a strong advocate of a very clear EBITDA measure, and within EBITDA, think about what you have to spend on the business to keep it in good order. So depreciation is there for a reason, but good solid multiples around that. But it will be impacted by factors. Customer concentration might bring multiple down in a particular sector. Concentration on suppliers might bring it down. Low margins might bring it down. So there's lots of factors that will go into what determines that end multiple, but they are emotive and they're never easy to pin down. And you can obviously structure deals in a slightly different way as well. So if someone's looking for a very high multiple, then doing it based on a deferment and an earn-out can help get over a valuation gap between vendor and buyer.
What would you be saying to anybody who's probably watching this and saying, well, we're a young company and we're still on a growth projection, therefore we don't need to think about exit planning?
If you intend to hold the business with a family for generations, then you might be right about exit planning. But circumstances change. And I don't think it's ever a bad thing for a company to consider who a potential buyer might be and how will you make yourselves attractive. Because in making yourselves attractive for a buyer, you're making yourselves a better, stronger company. And therefore, what can be wrong in making yourself a better, stronger company? It's just understanding where you fit within your marketplace, the things that you can do to make yourselves more attractive. And that means that either you've done it for the benefit of your existing shareholders, or you've done it for the benefit of people who might want to acquire you. So I think it's always good to be thinking and going through that exercise, and a board should really be doing that continually. The point about being prepared is to ensure that if there are issues within the business that are difficult to explain, that you can think about how they're addressed. So be aware that if you're in a volatile part of the world and you've either customers or suppliers from that part of the world, you might need to think either about what would you say about contingency planning or how you would address difficult questions from buyers or investors.
I want to stay with this a little bit longer. Talk about businesses who are thinking revenues have dropped and we have an expectation that next year, therefore, we're going to wait and hold out to have that conversation. I know buyers are always paying for future potential, and there could be underlying issues there as well, or leadership burnout. Do you just want to talk about businesses living on the hope of getting higher valuation?
This is the same whether it's selling a company or selling your shares or whatever. We don't know what's around the corner. So kind of hoping that things will come right, almost it goes the other way. So I think it's very difficult to hope for it. Now, it's different if you've had a difficult year in revenue, but you know you've got some orders and contracts coming through in the subsequent year to say, well, I know it's going to be a better year next year. Therefore, I want to present that in a good way to prospective buyers. So I'm going to kind of smooth this out and show growth over the 2 or 3 year period. Then that's fine. Simply hoping that things will come better, I think is a recipe for disaster. I think kind of take charge of your own destiny. And if there's good reason to think that sales next year will recover, think about how you present it. But equally, be cognizant of what's happening to margin as well. So there's more than one component in looking at the performance of a company. And if you've bolstered sales because you think we're going to sell next year, so we want the sales to be as high as they can be, but you've sacrificed margin on that, that will simply ask us another question somewhere in the due diligence process. So buyers are very well aware of accounts being prepared in the year or two before sale for things in there that might not be recurring in good terms or are recurring in bad terms, and they'll kind of look out for them. So don't think that you can fool everyone all of the time.
I think the analogy is...
Books, yes, it is, yeah.
Let's just talk a bit about defining the vision and the longer term goals. How do you approach personal goals, particularly when you are looking at different exit types, which could apply here, whether it's a trade sale, management buyout, or floating a business?
So we probably saw some of this as COVID began to hit, because you'd got people who I think were at the time saying, right, I'm ready to sell my business in the next 6 or 12 months. And the business takes a hit, the economy takes a real hit, and suddenly it's not the right time. So personally, you might be ready to retire, but it just wasn't the right time to sell your business. So I think you've always got to be alive to macro events that kind of knock you off course a little bit. But if you've got personal goals and ambitions that really can't be moved, then you've probably got to compromise on how or who you sell the business to, or on what structure you sell it. So, for instance, we've talked already about if you've got a valuation ambition, but a buyer's not ready to prepare that, then you might need to defer some of that and take a deferred income from the business to support your kind of personal life if it's really important that you get out. If you want to maximize the valuation of the company, trying to do that at the optimum time around buyers and markets is the way to do it. And if that means either selling early or hanging on a bit longer, then that's what you'll need to do. It's very good sellers of businesses, and those who sometimes have sold multiple businesses will know when to get out early. They'll build something, they'll get it to a level. It will look to others like there's lots of potential to go for, but they'll bank it at that time. And that's just a very savvy, very experienced seller recognizing that it's not worth losing what you've built for that little bit extra gain. But it's not a science because we don't really know what happens tomorrow.
Let's just stay with that timeline misconception. Are there any practical indicators or milestones that signal it's a time to start thinking about exit or a sell? I mean, a good one always is the leadership burnout.
Oh, so that was the one immediately sprang to mind, is if you actually see the team getting a bit tired and a bit complacent around what they're doing, then either it's time to change some of the team or it's time to think about selling to, maybe a trade sale where a management team comes with it, depending where you've got the company at the time. The other one is looking forward into what's happening in your market. So are there challenges? Is there disruption on the horizon for your sector?
Are we talking regulation, red tape?
Regulation can be one because regulation generally means there's more cost to your business. So if you're doing the same, the profitability is going to be lower because the cost of regulation will kind of, have that effect. So if you can see that coming in, then the valuation of the business is going to be less. You might think, actually, that's only going to get worse. It's only going to get tighter and tougher. Now might be a good time to get out before that impacts me, even if it means you're not going to get quite as much as you thought you were a couple of years ago. It isn't just regulation.
If there's not enough capital in that ecosystem, that's a warning sign or market dynamics.
It's a market dynamic, but it does impact things. So if debt fuels...
it's going to impact valuations as well.
If debt fuels business growth and debt dries up, then actually the whole market's going to be disrupted and there isn't the liquidity to support the valuations that you want. So yes, it will, that can impact it. That's very difficult to see though. That's generally happened by the time you see it. But there's, just in markets, if you're in a very intense people-centered business and you think about the impact of AI, well, actually, if things are changing, are you adapting to those changes? There's lots of new technology around. Think about your business model and whether that's going to be impacted. Because if you don't keep up with it, then your business will become worth less and less.
There's been times, you've had conversations and people will say, my business is worth a multiple of 12.
Yeah, it's just that people hear a range. So somebody says, what sort of multiple would you apply to my business? And they'll say, 8 to 12. They only ever hear 12.
Yeah.
So it's like if you go a range for selling your house, you only hear the top number. Whereas in reality, the reason they've given a range is because they think it's at the bottom of the range, but they want to make you feel better by giving you a range with a higher number in it. So it's just having a bit of pragmatism around it.
So let's start with sort of early stage focus, building the foundations of a buyer-ready business. Why is scalability a crucial factor for potential buyers, and what are some of the practical steps a business owner can take?
Well, scalability is there because whoever invests in the business in buying it wants to make a return on their money. So if they buy it today at today's valuation and sell it tomorrow, they make nothing on their money. And if they sell it in 2 years' time, they make nothing on their money if it's still the same. So you want to make sure that the business can grow and grow quickly, and then you can begin to get a multiple return on your money. So any buyer wants to see that the business is set up in such a way that they can grow it without having to put lots of building blocks in place. If you have to do that, if I'm looking at a business and I know I'm going to have to do a lot of work around infrastructure in there, then I'm probably going to knock the cost of that off the valuation on day one. Whereas it's much easier for the business to install that as you go along and have it properly set up for scaling and growing.
Let's talk about operational efficiencies. What aspects of operational efficiencies matter to buyers during a due diligence process, and any success stories of a business that has enhanced its appeal by streamlining the operations prior to its exit?
I can give you the opposite view. So Lloyds Bank sold the TSP business to Banco Sabadell, Spanish bank, but they left the customers on the operating platform of Lloyd's. So it was a requirement of the state aid that Lloyd's received during the financial crisis. So they had to sell a chunk of their business, but they left it on their platform and sold it to Banco Sabadell. 4 or 5 years later, maybe a bit longer than that later, they needed to migrate the customers from the Lloyd's platform to the new TSP platform. And if you look back, that was an absolute disaster for them, where customers lost access to their accounts. So what was a good business and a valuable business bought from Lloyd's, I think for the shareholders of Banco Sabadell, didn't turn out very well, particularly during that period. And Paul Pester, the chief exec, lost his job over it. So I have an example where if you don't do it well, it can come back to bite you further down the track. But you always want operational efficiency as well. It's the same point as scalability, which is if you're going to grow the business and you've built some operational efficiencies into it, then as you grow, you will get a better return for shareholders. It's what happens a lot with larger companies and PLCs selling a division. So you're not selling a company that's fully formed and fully set up. You're selling a division, and you think that's fine because we can just separate it and everything else. And it's not as migrating from platform to platform is never as easy as you think. You never quite count all of the costs when you're separating, and you never quite capture all of the customers. So it happens quite a lot, and it's something to be recognised when you're doing it. And I would say that if you're acquiring, you need to structure in that risk. So don't pay for it all on day one. Actually make sure that you've got milestones where you've captured all of the business that you want. I think arguably the reason that NatWest struggled to sell the Williams and Glyn's business out of RBS post-crash again was because they couldn't separate it. It's too ingrained in different systems, different platforms within the organisation, that if you moved a customer, you couldn't be certain that you're taking all of the revenue streams associated with that customer. And therefore it never happened.
So looking to become sale ready, do I digitalize my business to enhance the value?
I don't think just digitizing will enhance the value necessarily, but if you can demonstrate that what that has done is secured the customers in a stronger way, has kind of given you some data, some efficiencies that allows you to improve margins, to sell more or improve the business, I think if you can provide examples on that, then that will make it more valuable.
Creating value, what risks does over-dependence on a few clients pose when preparing for an exit versus a development strategy of growth and getting funded?
So customer concentration is one of the big reasons for company failure. And no matter how many times I've heard about why this customer can't leave a particular company, it happens and it happens and it happens again. So anything where there's very heavy concentration on one customer, I personally would be very wary of. And let me give you an example on that. In the food industry, lots of private businesses selling into supermarkets, into Tesco, shall we say. If Tesco know they're 80% of your business, and they know that you've just been through a buyout, private equity-led buyout, then they know that you've got a level of debt now that needs to be serviced. And their ability to exercise power and leverage over you becomes stronger and stronger. So, and you can't say, oh, that's okay, we'll kind of move to our other portfolio customers, because they might be 80% or 70% of your business. So it's that power and leverage in either that scenario or just generally that really leaves you wide open to mistakes. And equally, you can do all the credit checks you like, but you don't really know what's happening inside that customer. And if they fail, then that's your business gone as well. So attributing value where there's customer concentration is really difficult, really, really difficult. And I've seen it go wrong on many occasions. I've rarely seen it go well.
So let's stay with that, because we are effectively talking about boosting profit margins. How do you improve margins versus debt management and adding bolt-on services to become more appealing to a potential buyer? Are there any key metrics that you suggest business owners should monitor to maximize the impact on valuations when exit planning?
So you can't artificially do this. So you can't change the business that you've got particularly. So all these changes should be because it's good for the business, and that will eventually be good for the sale. So Let me take them one at a time. I mentioned margins. Well, you can't, if you're able to widen margins, then that's what you would do anyway, whether you're selling or not. That would improve your profitability. So if you can widen margins without risking the business, then that's something that you would do. The danger in that is that you think it's a great thing to widen margins looking for a sale. So I'm going to put up my customer prices. I'm going to kind of squeeze my suppliers a little bit. I'm going to widen the margin, and that'll be great for when I sell. But if that means that you lose a core supplier or you lose some customers, and your revenue then gets harmed during the due diligence process, and you haven't really done much to your business. So you can't artificially do this to make it look a good deal on paper. And I said due diligence will kind of find most of these things out. Now, if you're in a business where you think margins can be improved, and this goes back to the 2 or 3 year planning, what always looks nice in a sale is where you are improving that margin year on year. So instead of one big improvement in year 3, actually doing that over a 3 year period will produce you quite a nice trend for people to look at. And if you then back that up with how you've been able to increase prices or reduce suppliers, and then it just makes it more appealing, more sustainable. So it's difficult to do things that are artificial for the business just to try and fool a buyer. But if it's good business practice, then why wouldn't you do it?
Let's just talk about debt management servicing.
Well, most businesses are bought debt-free, cash-free. What debt can do, though, is fuel your growth until you get to that point. So if you've used debt to buy the business or build infrastructure for the business, and then you're beginning to leverage from that and grow the customer base, grow the revenues, then debt works very well for you. It just gets deducted from the valuation at the end of it. Same for cash balances, but that's probably less relevant. Yeah.
You tend to find a lot of private businesses, they have thought process whereby debt is a bad thing. And actually debt can, if used correctly, could actually enhance the growth and exit plan.
Yeah, private and family businesses, particularly those that might be generationally held. So the incumbent generation feels a huge degree of responsibility, and they would see too much leverage and too much debt as a threat to the business. So if times get tougher, I'm going to lose the whole business. Whilst you might be able to start a business again, you can't replicate 150 years of heritage. So they tend to be a little more cautious in their outlook. They'll be cautious with debt. They're also cautious with multiples. So actually some of those private businesses, smaller private businesses, if you start talking a multiple of more than 6 on things, they will think, that's really expensive. Even though you can maybe buy at 6 and sell at 8, they still think it's expensive. So there's a conservatism in private businesses, which is there for a reason, for protection, and to make sure that they stay alive during difficult times. I've seen a lot of financial engineering during my time, and a lot of business models on spreadsheets, where someone will tell you that the model shows that you've got X amount of headroom and everything is okay, and it can stand this level of debt and maybe some more. But they never show the shocks on the model, so they never show the thing that will kill the business. And if you're in a private family business that's been around for 200 years, you want to make sure that you can withstand that really difficult time when it comes along and the business doesn't fall into administration.
Let's talk about optimizing stakeholder engagement during an exit. Why does stakeholder engagement matter to a potential buyer?
Depends stakeholders we're talking about, but let me give you one misconception. That number of times I've had teams providing debt talk to me about a business that's been sold, and they'll say, oh, the owner, he's been in it 20 years, but he doesn't go in very much these days, so it's not really important to the business anymore. And I often say, look, in my experience, 30 million of value doesn't appear from nothing, so they must be doing something. And when you dig into it, you find that they hold the key customer relationships, which they do remotely or they do on the day that they go in the office. So they don't go in the office very often, but actually maintaining relationships with those customers is absolutely paramount. So if you're a founder who's going to be selling and moving away, you need to think about how you're going to facilitate the transition from your ownership to a new management's ownership or to a trade buyer's ownership, because that's that's an important part of what's been bought.
If someone's watching this and let's say they're looking at an exit, but they've got disgruntled shareholders or maybe even employees, we've been engaged to take people on a journey.
Yeah.
What advice might you share, given we've had to do some hand-holding in that process?
It all comes back to communication. And I think as much as you can communicate, then you should. You can't always. But consistency, I think, is also important, which is a consistency of message, a consistency of why we're doing this and where we are, and let people know what the next steps are and what to expect. So kind of try and keep surprises or changes of direction to a minimum. But it isn't easy. It's a real juggling act to ensure that everyone is as up to speed as they can be. And I considered in the planning that you might be going through. Employees is the difficult one, particularly if it's a private business selling. So the shareholders, they've probably known them a long time. They've been part of the family for a long time. You can't go out and tell the employees that you're thinking of selling the business and that you're going to put it on the market. But they might find out. So how do you kind of keep communicating with them about where the business is and what it's doing? And all you can do is release information along the way that help them understand, give them reassurance about what's likely to happen to the business, because ultimately they're worried about their jobs, and just give as much reassurance as you can. It's a very delicate and difficult process.
I want to stay on that. I've dealt with a business. One of the shareholders is ready to sell. The other one's really not. They're sitting on the fence. If the other one will sell, the other one will stay in the business, vice versa.
Yeah.
And it makes it a quite complicated situation. And actually, it makes the buyer also nervous and think, actually, I don't think I want that business because they're not effective at making decisions.
Well, it's just by being aligned. So they're not aligned in their ambitions and aspirations. So it makes it difficult.
That can put off potential acquirers, which can impact not only the sale process, but also what price up you come back to me tomorrow and you want to re-engage. You've left a bit of a distaste in my mouth. And I don't think sometimes people understand the journey they're going on. They always think, I'm an attractive business, someone's always going to buy me. And
no, I think if you're in a situation where there are two shareholders, this is something that should be addressed when you set the business up. So when you're thinking of where you are or you're thinking about the exit, this is the sort of stuff you need to think about and deal with then, rather than at the end of it when you're looking to sell. Because it can be very emotive, it can be very draining, and it's much easier if you've got a clear path that you both want to go on. And actually the process being, if one wants to sell, the other doesn't, well, how will you handle that? And if you've talked about that before and got that set up before, it makes these situations easier to manage and to navigate. But I can't think of many people who would want to buy into a shareholder dispute situation. Whether you take everyone out and only yourselves, or you do nothing. You don't want to step into what is an internal fight.
Let's talk about financing growth and finding the right investors. How can businesses align their financing choices with their longer-term exit goals and some of the trade-offs between maintaining control and seeking outside investment?
So, as ever, this starts with, well, what do you want to do with the business and where do you want to take it? So, do you want development capital for growth to invest in plant, machinery, premises, people that's going to help you grow the business organically? Do you want to make an acquisition? And in doing so, how much debt do you think is safe for the business? And if you're going to need more than that, then you need to consider an outside investor. So that's how you arrive at where you are. Whether to take in an outside investor isn't an easy journey. You need to give yourselves plenty of time to work through the process. Minority investment is different than a majority. So if you're thinking of real growth and development, then someone like BGF was set up for the very purpose of providing minority capital to allow UK companies to grow. That's why they're there. The reason minority is easy because you're not losing as much control in that situation, but you're using outside capital to leverage growth more quickly from the business that you've already got, or the combined business if you're acquiring something. The one that's harder, I think, is the one that says, I'm going to sell a majority stake in my business to we'll say private equity, because I want to make a transformational acquisition. And I think that we can generate real value for everybody in this, even ourselves as a minority. And what becomes hard, I think, is moving from when you might own the majority of shares to then effectively working for somebody else that owns the majority of the shares, even though you've got a share of the upside. So I think that piece is really hard for people to go through. That works better when it's a management buyout, when it's the management get an opportunity to make some money for themselves, but the previous owners are exiting and they're taking their kind of cake off the table at that time. So lots of considerations when you're taking outside equity in. But it's got to be aligned to what is the opportunity and what can you do with either growing organically more quickly, or can you acquire something that the two things combined will create more value in the future.
How can businesses best prepare for due diligence process? And can we cover some critical areas which need addressing ahead of time?
So legal due diligence will be about kind of structure, contracts, that sort of thing. So make sure that the legal work is all around, make sure the documents are all around, make sure that if there's any gaps in stuff that's tidied up. But, it's a process to go through, but you should have the documentary evidence for that. Financial is pretty much the same. Make sure that the kind of financial records are up to date, but think about where that might take you. So we talked about customer concentration. What follows on from that is an analysis of how customers have changed over time by sector, geography, whatever it might be. So think about what questions a buyer might ask, what might help portray your business in a strong light, and have the evidence or data behind it to satisfy a due diligence requirement. So it's all about anticipating what are the difficult questions that might come your way and how will you address it. Customer due diligence is another one. We've talked a little bit about customers, but some buyers will want to talk to the top 5 or 6 customers if they're of a significant size. So think about how you're going to navigate that message with your customers when you're preparing for sale, but it might be an important piece of due diligence.
I would also back to people due diligence, a human capital perspective. Also want to just touch on building the right exit team. It's essential the right advisors support you with that sale process. Businesses want to maximize returns and therefore keep the costs down. What qualities make an outstanding advisor and how can they drive better outcomes?
A good advisor is someone who understands the market and understands how that market is structured, who the key players are, what impacts are coming down the line. So they can really position your business well. They then need to be people who are able to bring two sides together, because no matter what, in any transaction of this nature, there are friction points and there are difficult points on both sides to navigate. So you need to be a solution finder and a peacemaker in all of this. Help keep morale up, because there are dips at times. Help keep morale up within the selling team, because it becomes, you've still got a day job to do, you've still got a business to run, and you need to keep it on track. So most of the sale activity is done outside of hours, so it can become quite tiring, and there are difficult moments. So you need an advisor that's going to keep the momentum up as well. They should be pretty good at anticipating what's required from the buyer in terms of information and data. So have you ready? So the question we just asked about due diligence is make sure that your data are populated with stuff that is relevant and easy to read and easy to interpret. And they've got to work with other stakeholders. So there's not just a buyer, but there's the kind of legal side of all this. There's other advisors on the other side, and they've got to be a good project manager. So it's doing all of that and keeping it to track and on time.
I would also add to that who's been able to create value. You want somebody who can think out of the box, that might bring you alternative solutions, more of a holistic macro view.
No, there is, without a doubt, because advisors can become a little lazy, particularly in that sector rush I talked about before, where such and such a business was sold to private equity, so we go and find the next one, and they almost want a cookie cutter. And actually, I would want somebody who's prepared to sit back and say, well, that is one way, but there are other people who might buy your business, from a trade, from a different sector, whatever it might be. So think about who you might want to own your business and how it's going to fit within that organisation. So you want an advisor that thinks all that through before setting off down a pre-planned route.
I think boutique advisories have a place in the marketplace because some of the more established players, they can be more picky about the mandates they're working on. Therefore, if they're only making, let's say, a couple of % working with you versus somebody else, then you're not getting the maximum value other than a brand name working with you.
I think inevitably professional firms will drift upwards in the value chain if they can. And every time they do that, they leave behind a market that's not served well, and people will fill it. And we've seen that in the M&A mid-market, smaller market advisory space. Boutique firms have kind of moved into that area, which, if you go back 20 years, would have had a KPMG and a PwC around it. But they won't take those mandates on now because they can earn more fees for larger transactions down the line. So there are horses for courses, and with a boutique firm, you probably get a little bit more flexibility of thinking, and you probably get more experience the whole time. So instead of a partner-led team of younger people or less experienced people, you might get more partner time or more experienced person time.
Let's just talk a bit about emotional readiness and preparing to let go, which is always difficult because it's like your baby. So what emotional challenges do business owners or leaders face when they're preparing to exit, and how can the business plan to navigate and identify shifts to prepare for that new stage of transition?
So I've witnessed this on quite a number of occasions where it's particularly a founder leaving, and they might have a set time frame in mind. They might have seen some business in their sector go to market, so they think it's a good thing to sell. They strike a deal with a buyer, whether it's trade or private equity, that will see them stay on in the business. And very few of them last much more than 3 to 6 months after the sale. And the reason for that is it's hard, if you've been the founder of a business and used to leading decisions, even if you've had a board helping you make them, leading decisions, to go from that to someone who's listening to a new board with a different direction. And inevitably the past gets criticised, and you'll feel that personally. You've banked some cash, so you don't need to work anymore. And that whole piece of a changed culture and environment, and the reduced need to work for economic terms, usually means that people go certainly inside of 12 months, if not inside of 6 months. I think I would always advocate on that if you're going to exit. Around, if part of the deal you need to be around to answer questions, agree to that, but don't think that you can be a meaningful part of the business once you've sold it. It's quite hard when you've owned it to then go into boardrooms where other people are making decisions.
The most important part of any exit planning, negotiating the best deal.
Yeah.
So beyond price, what key terms should owners focus on in leading negotiations?
And the first one is deliverability. So, you get a business ready for sale, you take it out, you get bids in from people, and you get a range of offers. And it's all right having an offer, but you need to go exclusive at some point. So you need to know what is the deliverability like. So that's the first one, which is actually, if you're going to negotiate a good deal, you need to make sure that the people can complete it, because you can spend an awful lot of time on people that can't complete or never had the ability to complete. Deliverability would be my first one in there. The second one will be looking at what matters to you most. So I've touched on this as we've gone out. If there's a dispute around valuation, it might be they say, well, we'll agree a valuation of 10 million now, but we're going to pay that 7 of cash now, and you get 3 in 12 months' time, 24 months' time, 36 months' time, whatever it might be. Then you've got to think about, well, is the increased valuation worth the risk of waiting for my additional money? And that's something you've got to look at in the context of who it is that's buying your business and their ability to deliver the deferred element later down the line. So there's a couple of things around valuation there. Tax planning is really important, actually, particularly with the budget just gone. You've got to think about what is the tax position. Most buyers are going to quote you a gross valuation for your business. You need to think, what does that mean for me in net terms? How much am I actually going to receive for it? So a well-structured deal might be better for you than a higher number of an unstructured deal. So you need some good tax advice around that, some good legal advice around putting the deal together. So there's many, many components of what a deal will look like that you need to go through to determine what is the best deal for you at that time.
That's all for today's episode. If you have any questions regarding exit planning or a deal structure you're working on and like some input, I'll include our email addresses below. Don't hesitate to reach out. We're here to help you, so please do ask any questions that you have, or if there's something we haven't covered, we'd love to cover it for you, so let us know what that is. If you found this valuable, you're in for a treat. We've got a treasure trove of interviews with other visionary business builders, all sharing their hard-earned insights. Don't miss out on the new releases. Subscribe to the Inner Circle Boardroom Visionary Business Builders. You'll find us on YouTube and LinkedIn. Hit the bell notification to stay in the loop. Till next time, keep aiming high and building smart.